Hi everybody, Jeff Yastine here. Welcome to another edition of Wealth Press TV. As always, remember to like and subscribe and follow us on social media. So now with that out of the way, let's make sure we welcome Roger Scott back to the program. Roger, welcome.
Jeff, how are you doing today? And thank you for having me on.
Yeah, it's great to have you on, have you back on. So let's talk about the first quarter. We're roughly halfway through it. What's your take on how things are going so far and how the market is shaping up at this point?
So far, I think the major stimulus is running the market. I think the market just loves this liquidity. It's driving stocks higher. Bonds are breaking down. Earnings are 85% or better than expected, but that's been priced in. The bottom line is, what I am surprised at is the fact that market internals, typical indicators that show us market turns are extremely overextended right now. They are extremely overextended. And we are basically at momentum levels are at an 11-year high. Earnings calculations are at historic highs. A lot of factors are showing us danger zone. But when you put together that with the fact that we just overcoming a huge economic, black or whatever you want, twilight zone or black hole, it's showing us that we have a robust enough foundation when you add all the stimulus, of course, to continue moving forward. But the question is, at what cost to America? How much of our future are we putting into the dumpster right now to survive? That's really the question. So we're looking okay. We're not looking bad, but in the short term, we're looking amazing. In the long term, I don't know. There's a lot of question marks there.
Roger, I'm curious your view on the importance of this $1.9 trillion stimulus package or proposal that's out there in the Congress right now. How important that is that to the market, and is that what the market is looking for and needs to have happen at this point?
I think we're way past that already. I think what the market is looking forward to right now is us getting past this COVID, completely getting past this COVID. I think we're now starting to see the rainbow, if you will, the other side of the mountains. I think that the new hope that things will get back to normal is starting to move on the market. And the impact of COVID. If you recall, I've been saying for a very, very long time now that what happened last February and March, and I keep going back to February and March, had a huge impact on the market long term. It shaped the economy and not necessarily what happened that time, but what triggered that time and the impact that it's had on the markets, on the economy, on the politics, and everything else is shaping our economy. This godforsaken COVID is shaping our economy for the next 3 to 6 years. Just to give you a little taste of it, okay? Electric cars, self-driving cars, disruptive technology, shortage in semiconductors. Technology has completely pushed itself forward in the development tech for the next 3 to 5 years. We now are where we should have been in 2024, maybe. People are not going back to work. They're embracing stay-at-home economy. They're embracing working from home. Large corporations are making deals with employees to start working from home. Let me give you a taste of how far this went. I was in Miami this last weekend. I went to Macy's in South Beach to look for some business clothes. It was my first opportunity to get out of the house and go shopping. I was excited. I went to the men's department. This is 2 days ago, 48 hours ago, okay? 90% of the shoes in the men's department were casual shoes. The store did not have business shoes. Why? Because people aren't having meetings with shoes. You don't even see business attire anymore. But the point is, everything is tailored towards the comfy, weight from the top of the waist environment. Sporting wear is every other person is wearing sports clothing. The world is changing, and I don't know if it'll go back. I honestly don't know. People like it this way. That's the whole thing. They're being productive this way. So I think this change is this thing that occurred to us has very long and substantial ramifications in its moving economy in a very different pace and a different direction.
Roger, given everything that you're talking about, how much of this is possibly already priced into the stock market in your view?
So we've had a huge push because of all of this COVID mess, I'll call it. We've had a huge technological push. Because of this huge technological push, we are just now, seeing a big spike in the demand for semiconductors, and there's a shortage of these chips. So now we're seeing a problem, another problem that was originally created by the problem that started with COVID, that had nothing really to do with COVID, completely changed the whole game again. They're talking about a multi-year shortage. I just did a video on this just before coming on here. There's a huge China, Japan, all the major countries are now going to start making their own semiconductors. Another major electric vehicle. The Biden wants to put charging stations in every mall, everywhere you see that he wants charging stations. That's a huge shift to basic materials. Would we still have the need for charging stations if we didn't have this COVID? Would he win? You see, it's kind of like it's the tail or the head. It's what caused this. So yes. So to answer your question in a very simplistic way, I think that initially, the impact of COVID, about 80% of it is priced into the market. With that said, about 20%, there's a huge question mark. And that's creating all sorts of demands as supply-demand issues. So in some aspects of the game, we are doing better than expected. In some aspects, we are not. And to answer your question, certain sectors have become efficient and certain ones have not, and they're not going to become efficient for many years to come.
Roger, last week the strategist at JP Morgan put out a report saying that he believed the market was at the beginning of what's called the new commodity super cycle, that commodities, not just oil, not just industrial metals, precious metals, grains, everything across the board that we consume as physical inputs basically is at the beginning of a new super cycle where the prices are going to move higher in sort of stair-step fashion, not just for a few days or a few weeks or a few months, but really for years on end. And I'm curious what your views or what your thoughts are on that.
I think it's all coming our way. I think I think very simple. Let me give you a very simple example.
Sure.
The Fed, we're not going to raise interest rates, right? Well, have you looked at the long bond lately? It's fallen off the cliff. Interest rate, long-term rates are going higher. It's just in the futures market, it is what it is. I mean, short-term rates may not. This curve, the straightening of the curve or extension of the curve is not. It's not going to be unnoticed. We are, in fact, it's called straightening of the curve, and what we're seeing is a very gentle but a very steady spike in some inflationary measures. There's no question about it. And you just mentioned basic materials. Keep in mind, we need these basic materials for different parts of the economy. Think about it. Did we need lithium a lot 40, 30 years ago? Now it's the lithium, that company Albemarle I've been talking about, yes. It has become a major commodity. So I believe commodity prices are going into, I think we are in fact entering a inflationary environment. I think commodity prices are in fact going to go higher. And also remember, the semiconductors are commodities. There's a huge shortage right now. That's also going to expand. But I think it's going to make its way into more tangible products and services, yes. But yeah, I couldn't agree with you more. And I think that's going to, I think that's been a trend that's been with us for a little while. And I think it's going to become more pronounced as we get further into the outcome of this COVID. And I agree with your analogy. It's been very much like a war. And the market is setting itself up for very low rates that are about to start moving up, very strong housing sales market, just like after the war. You're very right, except this time, unlike the war where we didn't have a lot of tech, everything is based in tech. So you're going to see tech impact our world from a technical perspective and not. Because remember, now everything in the world, not everything, but most things are powered by technology. So when you have technology powering your remote control to your garage door, well, is a garage door a mechanical item or is it a technology item? It now becomes a technology item. Sensors for your animals, for training. It's not a leash anymore. It's now a computer. You see, so computers now is little by little creeping its way into our everyday lives, which is why consumer discretionary and technology don't have a very clear separation anymore. So, but in an ultimate sense, you're absolutely right. There's a big change, fundamental shift coming, and what technology is doing it's distorting it, and it's creating a lopsided economy because we are moving and relying more so on tech, chips, and so forth and so forth.
Roger, I'm curious how far and how long you think the Federal Reserve will let the market and the overall economy run hot or run hotter, because the Fed has, of course, supported the stock market. It has supported the economy through, basically its easy money policies. And now that we are at all-time highs and have been at that level for a while, and we're starting to see all kinds of commodities start to shoot higher and get higher prices, at what point does the Federal Reserve basically say, you know what, we think we've let this thing go as far as we should, and we're going to pull back now?
They're going to do it till it takes till they have evidence that the economy can stand on its own 2 feet. And I think we're very far from that. I think we need to see GDP close to 2%. But what we do have is we have history, and we saw how it all turned out in 2008. They did it for about I think about 4 to 6 years.
Yes.
And I think we're going to see something similar. Obviously, it's going to be different infusions and different timing and all that. But they're going to be here to stay. The whole theory about the stock market and the Fed being completely separated, I think that, if this doesn't show an example of how that's just complete nonsense, I don't know what else will. The Fed is extremely vested in the stock market and the bond market, extremely vested, because so much pension money and retirement money is in the stock market. It's not the same animal it was 50 years ago. It's a whole different beast now, which is one of the reasons why the markets recover so much faster and are so much more dynamic than they were back in the day.
Well, Roger, considering everything that we've been through, then how should people think about the market? How should they approach it at this stage of the game?
I think the key word is nimble. I think you have to be very, very nimble, and you have to think short term right now, and you have to be savvy and patient. Nimble, savvy, and patient. Those would be the top 3 terms. We should probably call that video patient, savvy, and nimble. But really, that's the key. I think this is going to be just because the market's going to be influenced by the Fed doesn't mean we're not going to be in for some turbulent times. We're going to see some turbulence. We're going to see a lot of volatility. I want to remind everybody that volatility works both ways. It works towards your position and away from your position. It's not a one-way street. It's a double-edged sword. Decrease your position. Consider ETFs when the markets get overheated. Play defensive. You don't need a lot of leverage right now because volatility is just going nuts. But what you need to be patient, and you need to be savvy, and this is a great time to start looking at technical analysis. Start waiting for stocks to hit the 50-day moving average. Look for pullbacks. Be strategic. Don't be buying at all-time highs when volatility is 2.5 times its average norm. This is not a time to be a hero. This is time to be defensive, savvy, and quick. There's always risks when it comes to the markets. I think this is definitely a time not to be a buy and hold investor. If there was ever a time not to be a buy and hold investor, it is right now. You do not want to read Warren Buffett's book on how to get rich right now. That's not what you want to do. You want to be a momentum trader that's looking at the moving averages, that's looking at price indicators. You basically want to be a wealth press guy right now. You want to follow us because we pick those turning points and sectors that are moving up and down. And usually, like our morning videos, I always tell you markets are overbought or oversold. And there's going to be a lot of opportunities this year, but you got to be patient and wait for them. I think the market's going to run hot, really hot, the first half of the year. But I think with earnings expectations starting to turn exceedingly higher, I think we're going to see some bumps in the road. Next quarter will be the first quarter since this mess with COVID started that earnings are going to we're going to let the markets kind of show their hand where they're at without pulling them down too much, because expectations are getting higher now. So the analysts are not going to be helping drive the market higher as much anymore by understating what the numbers will be. They're going to do the opposite, which means the hurdle is higher now. And that means we have to really find value and momentum. And that's not hard. That's not easy to do in this type of market environment.
Well, maybe we could talk about winners and losers in terms of sectors or particular stocks, whatever you feel comfortable talking about here, as far as the potential winners that are out there and the ones that people might want to avoid or lessen up their exposure to.
Some of the best sectors right now, and these are low-hanging fruit: pot stocks, electric vehicle stocks, small cap tech stocks that are grounded in global economy instead of U.S. economy. I think that's where the money is right now. That's where the big and semiconductors and large semiconductors. Matter of fact, I think that's, if anything saves the NASDAQ, the large NASDAQ, from a big downfall, it'll be those semiconductors, because we are in a position where we have very, very little supply and huge amount of global demand for them right now. And this is only going to increase.
Well, Roger, I'll circle back to semiconductors in a moment. Let's talk about pot stocks, because it started to get, as a sector, get hotter after Election Day, and especially hot after the Georgia Senate races finished, and it became clear we'd have a Democratic-controlled Congress and, of course, Democrat controlling the White House as well. What's your view as far as just in the past week, we've seen this tremendous sell-off in many of the names in that sector. I look at it as an opportunity. What's your view?
This is something good to address at this point. Any growth industry is going to have sell-offs. That's just the nature of the beast, right? Because you have aggressive accumulation coming in at a fast pace. So anything that moves forward will move back. As I said, it's a double-edged sword. If you don't like that, deal in Walmart. It's not as volatile. But to address the question and the issue, we are right now literally at a crest of a global, or at least a national, marijuana tidal wave. From a political perspective, Democrats are probably going to legalize it over the next 12 months on a national basis. You have now presidents and CEOs of national and international marijuana corporations, billion-dollar corporations, putting that in their projections for the end of this year. It's uncanny. So I think we're finally here in prime time for pot stocks. I think we're in the right place at the right time. And honestly, that's the biggest factor. Also, several states, including some southern states that have been kind of unfriendly towards marijuana, are completely turning the eye. Texas is starting to recognize medical cannabis. Other states, other conservative, Mississippi, the point is Alabama. The point is that there's no going back. We're not going backwards. We're only going forward. And I think we're in prime time. I think the odds of it being legalized on a federal level during the next 3 years and 10 months is almost a certainty. And one of the stocks that I really like is I like the stocks that don't necessarily grow the marijuana or sell marijuana. I like the shovel stocks. I like the stocks that provide the supplies, because those stocks aren't dependent on a particular stock. They're just particular on the whole thing getting bigger. That's where the money is, in my opinion.
Okay, and then let's talk about semiconductors, because as you were saying, if there's an effort going on out there in China and other countries that are wanting to not be left behind, essentially, in the race for technology, can U.S. companies, semiconductor companies, which dominate this sector, can they withstand some foreign competition?
Absolutely. What Trump did was useless. I mean, look at companies like Teradyne. They have a huge market cap in China. No, the bottom line is this. Right now, Japan is getting on the chip making wagon. Europe is getting on the chip making wagon. This is if the future of global technology is not in nuclear weapons, it's in semiconductors. And whoever has the best semiconductors is going to be the leader of the world, of the free world, because we're not going to be grounded in fear and killing each other. We're going to be grounded in making money from each other. The world is becoming one, and there's no going back. If history has taught us anything, people are getting friendlier towards each other, not more adversarial towards each other. And there's just too much downside with wars for everybody. Nobody wins except production companies, like Boeing. I don't want to get into all of that.
Right.
But the bottom line is this. We are realizing right now that the demand for semiconductors in every aspect of society is increasing at a substantial clip. And you're seeing big companies like Applied Materials, KLAC, Micron, Applied Materials. You're seeing them drive in overtime right now. They are driving overtime right now to make these machines, to make semiconductors. For the 5G technology that's coming out and ramping up this year, you need new chips in the iPads to make them function at a 5G level. They're busy with that right now. Everything, these Peloton bikes, these self-driving cars, all of them need chips. And without chips, you can't progress technology. And if you can't progress technology, what are you worth now in the global marketplace? So technology is just in the infant stage right now for where we're going to be in the next 10 to 20 years based on projections. It is growing at a disruptive pace right now, which is in line with electric cars, except chips are 50 years old.
I think people sometimes, though, find it, especially if they're not used to following the markets, they're trying to figure out, all right, how do I make sense of the markets? What kind of solutions do you think you can present for them to help them figure things out?
Well, number one, start looking outside of US. Start looking at global markets. Global markets, third world countries like Vietnam, Korea, North Korea even, they're starting to shift into first generation technology. You cannot keep progress back. So as a result, you're going to start seeing a lot more smaller stocks making headways. You're going to start seeing smaller stocks make run-ups. This is why I'm starting to look at the Russell 2000. I think if you can focus on global tech, global exposure, and smaller cap stocks, you will find yourself in a really good space for the next couple of years, because smaller stocks have been lagging behind the broad market. And I think finally now they're starting to outperform, and I think this trend is going to continue for some time. So, and also, I don't think I see a lot of investors trying to guess which stocks will go up next. They're looking at airline stocks. They're looking at cruise ships. Folks, there's no need for that. You don't have to think three steps ahead. Just focus on low-hanging fruit, pod stocks, electric cars, self-driving cars, lithium batteries, charging stations. That's where the money is. That is where the money is. You don't have to go and try to figure out what the next stage of tech development will be. You don't need to do that. The money is in front of us. It's a low-hanging fruit, and it's up to you to go and just grab it and take it.
Well, Roger, given all the challenges that are out there and the conflicting signals and what have you, what within your range of services do you think people might want to look at here so they can get some good answers?
Sign up for my newsletter. There's no cost. It's free of charge. And you're going to get the insight daily. You're going to get the type of insight that Jeff and I are talking about right here. You'll get it daily delivered straight to your inbox. There should be a link below this video. And most importantly, don't increase your exposure too much right now. Markets are extra volatile. You don't need a big position to make or lose money. And remember, markets are a double-edged sword. If there's potential for massive gains, there's potential for massive losses. So you got to control risk.
Roger, it is great having you on. Appreciate your wisdom and your insights for all of us.
Thanks, Jeff.
And for all of you, make sure that you like and subscribe to the program, follow us on social media, and we'll see you again next week for another edition of Wealth Press TV.